Welcome to the Power Market Report. I'm Albert Liu. Well, big move today as the Dow rallies over 1,200 points as the coronavirus case growth appears to slow in Europe, yet many problems still remain. With me now is Don Luskin, Chief Investment Officer of Trend Macrolytics. Don, thanks for joining me today. How are you?
Great pleasure. I'm terrific. How are you?
I'm great, Don, considering all things. We had some good news on the health front. But there's lots of other things that we need to watch here in terms of markets, economies, and our investments. What stats are you in particular following now?
I happen to believe that while the coronavirus is a real thing, I'm one of those people who thinks it's just kind of like the flu. And I am not sure why we've decided to cause a global depression in order to stop it when we've never done that before for an infectious disease. So what I am looking at most carefully is what governments are saying. I'm looking at what they're saying about when they're going to reopen the economy and let us start recovering. And they are following the lead of the infection curves and the death curves. So if you want to know what the governments are going to do, I guess you got to know what the virus is going to do. So my favorite indicator is I'm looking at, on a global basis and at every country individually, I'm keeping track of how many days it is between each time the number of deaths doubles, right? Because when this first thing started, remember that everyone was saying, oh my God, viruses are like, they're like Moore's law. It's exponential growth. Well, anything that grows can be understood as exponential. Everything doubles eventually. You may have to wait 100 years. And the thing that made Moore's law such a miracle for technology is semiconductor density doubled every 18 months. That was pretty impressive. Now, right now in the United States, deaths from COVID 2019 are doubling every 4 days. So that's seriously exponential. So we want to see that become 4 days, 5 days, 10 days, 20 days. And that's what's now finally happening in Italy. That's what happened a couple months ago in China, even if you don't believe their statistics. So that's what we need to see. We do not know how many people actually have the coronavirus, but we definitely know how many people are dying. It's really clear to know when somebody's dead. And when they're dead, you test them and see if they have coronavirus. Now, it could be that they were going to die of something else anyway. It could be that there's a guy who gets run over by a bus and you test him for coronavirus and you say, oh my God, he's got it. I'm going to call that a COVID 2019 death. Well, those statistics aren't perfect either, but death is a better indicator than anything else. So that's what I'm watching. I want to see that rate of doubling slowing down. We're seeing it a little bit now in the United States. We're seeing it a lot in Italy, a lot in Spain, a lot in the UK. So it can be done. We're about a week behind the rest of the world because we were the last country to get it. So that's what I'm watching. And as that evolves, the pressure on the political class to let us get back to work. Stop listening to these ridiculous doctors who a month ago were telling us that wearing a mask doesn't help. And now they're saying you must wear a mask. Oh my God, make up your mind, right? So these people are absolutely useless, and yet they are absolutely ruling our lives. They are causing a global depression. So we need those death curves to roll over. We need these experts to get out of the way and get back to work.
Okay. How about if we move to the banks? Jamie Dimon out with his letter saying that he may have to suspend the dividend. We had, I think, HSBC suspending their dividend. An indication that this is could be very serious for them, even though we thought they were strong. Where do you come out on that?
Well, they are strong, but this is a recession, Albert. And in recessions, banks experience stress. They want to conserve capital. They want to do what they have to do with their capital to serve their customers so they can keep lifelines out. So, the last thing a bank really wants to do is foreclose on a customer. If possible, you want to forbear and get it so that a couple months later that customer can make it and make up for a couple of missed payments. So that means you take care of your customer first and your investor second. This is classic recession behavior for a bank. It doesn't mean the world's ending. In fact, if they didn't do it, you'd really have to worry. You'd wonder, why are they returning capital to shareholders when the customers need them?
Right. Okay. Let's talk about the oil market, Don. Last time we spoke, or the time before, you said, look, the president really just needs to get on the phone with these guys, get them talking. they are sort of talking. They were going to talk. They're not going to talk until later this week.
Yep.
How do you read that? How is that going?
Well, it's progress. And the respective leaders of Russia and Saudi Arabia are in a public spitting match, and that's what you want to see. That means they're engaged. They're trying to puff themselves up and preserve their pride. So as far as the public is concerned, they're all strong leaders who won't get pushed around. In the meantime, fine. Mohammed bin Salman and Vladimir Putin aren't doing a Zoom conference call together, but I guarantee you that their underlings are, while they spit at each other in public. And the fact that they are establishing their defense perimeters and looking strong is what allows their underlings to work this out. They are going bankrupt. They cannot go on this way. It is just a reality that we've got anywhere from 20% to 50% sudden hard stop in demand for oil globally. You have got to cut production when that happens. You just have to. And the U.S. should do it too. It's not a question of manipulating the market. It's not a question of being a cartel. It's not a question of monopolizing or anything. For God's sake, there has been a giant crash in demand. You have to produce less. Every business does that when there's a crash in demand. You don't just churn out the same number of widgets when there's no widget market. Where are you going to store them, right? So they've got to do this. And what are they going to do? Produce oil that nobody can even store and sell it to people who can't store it at a below break-even price? Oil prices 10 days ago were at a point where even Saudi can't really break even. What is this? Some kind of suicide mission, or are we in this for the money, right? So this is going to take care of itself, believe me. And it's just a question of a couple of leaders getting their pride out of the way. It'll happen. It'll happen in a matter of days.
Don, in terms of U.S. production cuts, is this something that's going to happen in response to market forces, just the price being as low as it is already starting to do that? Or does the Texas Railroad Commission or whomever decides things like that have to get involved and institute supply cuts for them?
Yeah. The only good thing about the Texas Railroad Commission stepping in, and by the way, that would only apply to producers in Texas, is that at least it would be a uniform thing that would cause everybody to, let's say, have the same pro rata production cut. That's not the worst response I've ever seen to a demand shock. You have to hope that once that regulator gets that little taste of power, that when the demand shock finally abates, which won't take very long, that the regulator will step out of the way and let the free market operate again. But if that's what it takes to get a disparate group of cowboys to agree to cut production, then I guess I'm going to make an exception and say, fine, let the regulator intervene. So, I hope that won't be necessary, because while that's the easy way to do it, you mentioned it yourself, there is a hard way to do it, and that is for the producers to just go bankrupt.
Right.
And that causes you to stop producing. I've always noticed that. So let's hope that it doesn't come to that.
Okay. In terms of the high yield markets, which I know you do watch, what are the developments there?
Well, they're off their worst levels, and that's really good. High yield markets didn't get to the levels that we saw very briefly in late 2008. They got back to a little bit beyond the levels that we saw in 2014, 2015, the last time we had a collapse in energy prices. And it's very useful that they haven't gotten any worse, because that's indicating that there is capital coming into those markets. It's indicating that those markets are saying that we've seen the worst. So that's all very good.
Last question, Don. Excuse me. We have the oil market, which it seems will eventually take care of itself one way or another. We have the health crisis, which eventually will take care of itself one way or another. What about Main Street? The government is trying to intervene quite heavily in Main Street with small business aid and whatnot. Are they doing the right thing?
Well, I don't know if they're doing absolutely the perfect thing, but they're doing something. And unlike the crisis in 2008 and 2009, everything the government did then was too little and too late. It doesn't do any good to put foam on the runway when the plane has already crashed. This time, the Fed and the Congress are doing something. They're doing their best, and they're doing it preemptively. They're doing it before anything has gone terribly, terribly wrong. And I think that's going to really make all the difference. I want to point out that I don't mean to in any way make light of anybody who ever loses their job. But we had that horrible jobs report on Friday where something like 700,000+ people lost their payroll job. About 5/8 of that were people who work in the leisure business. So that would be restaurants, hotels, that kind of employment. That is the bottom of the rungs of the employment ladder in the United States. That's where all the lowest income, most mobile, most fungible labor operates. So that's a great human tragedy because these people have absolutely no reserves in their life. And when they lose their job, they lose everything. But these are the people who, yes, they're easiest to fire, but they're the easiest to hire. And if you can work in one restaurant, you can work in another. So in a couple of weeks, when people come out of their shelter-in-place posture, and let me put it this way. Let's just assume that a lot of people in America have my wife's attitude. When this is over, we are never going to cook at home again.
Yeah.
Right? She's going to put a leash on my neck and just take me from restaurant to restaurant. And I'm telling you, every one of those fired restaurant workers is going to have 2 jobs if they want it. This thing is going to come back so quickly. I know it seems like a horrible tragedy because it's so easy for them to lose their jobs. It's just as easy for them to get them back. And these are exactly the kind of workers that the so-called stimulus bill, which is really a relief bill, was effectively designed to protect. All of these people will get the unemployment benefits they would have gotten anyway, plus a top up from the federal government. If we can just get them back to work, say in a month, it'll all just be like a bad dream and it will be fine. They will be fine.
I think your sentiment is shared by a lot of people, including those in my family, Don. We are going to go crazy the first chance we get, I think.
Absolutely.
Last question, Don. The Fed is really extending to do this proactive, to do these proactive exercises. Is there a level of the balance sheet? We've talked about this before. You said, look, it doesn't really matter. Is there a level where you start to get uncomfortable, though?
I can't put, I guess there is. I just don't know what the dollar value of it is. It sure seems like right now, Mr. Market is telling us that we have not reached that level. As the Fed has done what it's done, added so much to its balance sheet. My goodness, you should look at a chart of it. It's just like somebody put a cattle prod on it. It's helped support the stock market. And I don't believe that's because of just some mechanical liquidity effect where the Fed is somehow printing money and people are going out and buying stocks. No, not at all. It's that is successfully restoring confidence in the liquidity of the system where, back in 2008 and 2009, when the Fed was tardy, you just had a bottomless stock market until the Fed finally figured out that it had to do this. So I think the levels that we ought to worry about with the Fed are the levels it doesn't achieve, not the levels it does. And they're pulling out all the stops.
All right. And speaking with Don Luskin, Chief Investment Officer of Trend Macrolytics. You can find him at trendmacro.com and on Twitter at Don Luskin. Don, great to talk to you again. Thank you very much. Take care.
Thanks, Albert. Stay safe.